Good afternoon, everyone. Stacy Scott. I'm client relations and marketing coordinator here at Wickham Financial and Insurance Services, and I'm also today's host for the webinar. Thank you so much for joining us today for our October Lunch and Learn. We hope you enjoyed today's session and learned something new. As we're entering into the holiday season this week, our session today is going to have a Thanksgiving theme. And throughout today's session, if you have any questions for Graham, please type them into the Q&A section of the chat box, and he'll address them during the question and answer section at the end of the session. As always, you'll see Graham's calendar pop up periodically throughout the presentation. And if you'd like to schedule some time to talk with him, please click on the calendar and select the time that works best for you. And now, without further ado, I'll turn things over to Graham.
Hey, thank you, Stacy. I'm going to change my slides over. So I really appreciate everyone joining the call. Really setting us up for this November timeframe, and a really, I think, fun call today because we're just going to do the Thanksgiving theme. So bear with us. Stacy has done it, and my marketing team has done a great job setting these slides up for this Thanksgiving theme. So we want to set the table, if you might, for this lunch and learn. And when we think about setting the table, think about setting your table for Thanksgiving, as well as you would be setting your table or your portfolio for your financial plan or your wealth management plan with your investments. So when we think about setting the table, first off, let's find a moment to look at being thankful. Sometimes we get so busy in our lives, and it doesn't need to be one time of the year, but this is the time of the year that we can sit down and be thankful for family and friends that are around us, our health as we're in a pandemic and hopefully coming out, maybe our career, right? So sometimes it's good just to take a moment to sit back and evaluate kind of where we're at and just find opportunity to be thankful. As we're thankful for, our general Thanksgiving theme, let's think about being thankful for things maybe in the economy or the investment markets. So as we take a little spin on being thankful. So let's look at returns. The S&P index is up 25% year to date. The NASDAQ has had a really strong return year to date, as well as the Dow Jones Industrial. We have a really strong consumer and consumer demand for products and services. We have the savings rate of the consumer for the consumer on strongest of all times at roughly about $4 trillion in money markets and savings accounts. Now, I'm going to go back to that here in a minute, but let's think about that. That's a lot of money sitting out there, not really making any money, and inflation is roughly 6.2%. So I don't want to get into some later slides here, but I just want that to be maybe something front of mind for you as we move forward. We have a really strong job market. As I mentioned before on some of the weekly wrap-ups, even on some of the lunch and learns, listen, think about the job market. If you want a job, it's there. I can't drive by or drive down the street or my way home from the office, and I don't see a for hire sign in windows of institutions. So it's a strong job market out there. We look at corporate earnings. We had corporate earnings, I think we're around 37% above earnings expectations in terms of corporations beating those earnings, as well as I think it was about 14% above on revenue. So we're having really strong corporate earnings. We are seeing some challenges here with corporate earnings in terms of gross margin with some of the retailers. And that's why you've seen like Nordstrom's and some of the other companies out there like Target or Walmart, stocks get hit a bit because not that they just be on top and bottom line, but these gross margins and how much they're making is a real question right now. But again, I don't want to get too much into question marks or negatives. We got a pandemic recovery. We're coming out of this, spurring demand, wanting to travel, all that great stuff in a really low interest rate environment. If we think about the 10-year Treasury, the 10-year Treasury right now ticked up a bit over the last week or two. It's up about 1.665%. Listen, normal ranges are probably upwards in the round of 3 plus. So we're still really low in the 10-year treasury using that as a benchmark for rates right now. If we think about inflation, and we talked about this on our last Lunch and Learn, we have an average inflation of about 1.9%. Now, I know because of the shutdown and the demand and just the desire to get out and about, has pushed inflation up to about 6.2%. But let's put it in perspective. Right before the pandemic, right before the shutdown, right? So we still had a pandemic. It just wasn't a shutdown. Say February of 2020, we had inflation rates of roughly about 2.1%. So inflation, even though it's high right now, it's been low for a long time. And as we talked about it before, how much is going to be transitory in this environment, meaning how much will go away to how much will stick. So let's kind of move into that next part of this. As much as we need to be thankful for things that are happening in our personal lives or with the markets, hopefully with your portfolios, sometimes we got to have a little humble pie, right? A part of our dishes with our Thanksgiving meal. So we got to think about, okay, what are some challenges that could be hurdles for this market going forward? We want to think about some valuations. Let me give you an example. I think everyone has heard about the Rivian that recently traded. So the electric car company had a valuation at one point, and this is about a week old here, at one point, a valuation larger than GM and Ford. That is astronomical. Think about this. They had only produced about 52 cars and distributed mostly all of those to employees. So it might be a great product, but completely unproven in the market. So we think about the valuation. Yeah, it shot up to $100+ billion company, higher than that. And it hasn't really even produced any products, even though it has a great idea. And we know to a degree that's going to be a wave in the future, but we don't know if Rivian's going to be a long-term for the future. We're going to think about rising rates. We know rates are going to rise. Rising rates, if you remember from previous calls, rising rates aren't always bad, but it's the pace of those rates. So how quick do they rise? That can put more pressure on the market's upward advancement than anything else. So again, rising rates, if you recall from previous Lunch and Learns, if you're on them, go to our website. You can check out old ones if you want to go refresh yourself. But rising rates aren't necessarily bad. Rising rates breeds confidence in the economy. Dropping rates is a more pessimistic view, but rising rates to a point says, hey, listen, we've got a strong consumer, we've got strong corporate earnings, and we need to stave off so we don't have too much long-term inflation or hyperinflation by rising rates to hopefully tamper down over enthusiasm. And that's basically where we're at. We know rates are going to rise on their own, as well as the Fed might instigate through tapering, as well as Fed funds rate increases as we move into December, which is the next Fed meeting. We move into 2022, so on and so forth. So rates are going to rise. It's the pace of, not the fact that they're rising, because it's not necessarily a bad thing. Stocks haven't always done bad. Now, they might have a little fit at the beginning, and depending on, and that goes back to valuations, what type of stocks they are, well, that can be the real question. Who gets affected more in a rising rate environment based on pace compared to who performs maybe a little bit better. So consumer demand is there right now. So that's not why it's on our humble pie list here. But what if we get to a point down the road, which I think we all know we will, right? We just don't know when consumers kind of sit back in their chair a little bit and say, hey, listen, I got the savings here. I've been spending money. I'm not getting checks in the mailbox or my bank account anymore. So government stimulus isn't there as much as it was. And then maybe they get into some of their habits in terms of less spending or less demand. All right. So we got to think about, okay, how are the comparable in terms of earnings going to look year over year over year if less demand is there from a corporate or personal aspect? And what will that do with earnings? Because we want to think about this with earnings. Earnings or stock prices generally go up with earnings. I mean, that's a fair, reasonable statement. But if earnings aren't there, or the year over year comparability is too challenging, or the estimates have been too high, then all of a sudden we could start seeing stocks coming down, and account for that, right? So we just want to be mindful that earnings are really good, consumer demand's really good. I'm not trying to rain on this parade, but it could put some negative effects with some of the stock prices right now. The reason why I brought up the pandemic, I know we're coming out of this. Things are improving, but from a pandemic side, from a global side, we're seeing Austria shut down or do a lockdown. Germany having some of the highest cases that they've had through the pandemic, exploring options of a shutdown. Some other countries like China or Vietnam with supply chain issues, that can affect the global growth. And then the question is, excuse me, globally, how much, or will that have some sort of effect on our U.S. growth? Still to be determined, but I think that's some question marks right now with oil supply, oil demand, so on and so forth. Excuse me, last but not least, inflation. I talked about it before. Inflation is 6.2%. Let's put this in perspective again. Pre-pandemic, right before the shutdown, 2.1. Over the last 15 years, we've averaged about 1.9%. So often, if you're a client of ours, you already know I'm going to throw this line out at you. If you're not a client, we talk about what's called lazy money. We talk about money that's not performing or beating or exceeding inflation, right? So let's give you an example. If you have an investment and inflation is 6.2%, and you have an investment that grows at 1%, well, you're basically losing 5.2%, right? If you have an investment that's getting 5%, inflation is 6.2%, you're losing 1.2%. So on and so forth, right? The other caveat to think about it is, are you being taxed on that? Are you being taxed on any income it's spinning off? Are you being taxed on any capital gains? So on and so forth, which is going to eat away. So we have gross returns, we have real returns, or your net returns. And in our environment, I love gross because that leads to your net or real return. But inflation is something that we have to be mindful of. Because I think the argument out there was, this is going to be transitory. It's going to move through the system. Don't worry about it. We'll get back. No, I do not believe, and I've gone on the record before, I do not believe, and it's showing to be true, very true, that it's not as transitory. Some is going to be sticky. Wage inflation is going to be sticky. When you're giving someone a raise, you can't just change that overnight, or you're not going to just change that overnight. That tends to be very sticky. If demand's still there, what's the likelihood of suppliers or distributors of goods, as long as there's good demand there, they're not necessarily going to lower their prices. Right? Especially if we got to think about supply chain issues, which are putting pressure on corporations that have to raise prices because their costs are going up to get goods to sell to the consumer. Right. So I think you get where we're going here with inflation. So we just want to be mindful of inflation, its lack of being transitory or not being as transitory as once thought. And how does that affect our exposure to certain investments to it in our portfolios to achieve our goals and objectives, either pre or post retirement, especially when you're in retirement, when we're thinking about more preservation and income than we are growth. I hope that hits home with everyone. I certainly beat that horse enough, I think. So if we're thinking about now the feast, right? So we're moving for what to be thankful for. That's really what Thanksgiving is all about. Now we want to think about how to position our Thanksgiving feast. So I kind of look at it as when we're thinking about wealth management, we're thinking about financial planning and retirement planning, or your investment allocation, think about it as your Thanksgiving feast, right? You don't serve just entrees. You don't serve just desserts. I would like just desserts, but I don't think my body would like that, right? So we want to think about appetizers and entrees and desserts. So we have to think about in our portfolios, what does that look like? What's the mix between stocks and bonds? What's the allocation between small caps and large caps? In this environment, do small caps outperform a little bit better in a rising rate environment, or is it large caps? If we're in a strong dollar environment, do small caps outperform compared to large cap multinationals? So we just want to be mindful of that as we're going through these challenges or just normal ebb and flows that we see over time in the investment markets. What looks reasonable, international or domestic? A lot of our conversation with our clients are, it makes sense to make sure you have good, maybe not an overweight, but you have good exposure to international markets. Why? I'll give you an example. Germany's having challenges with COVID cases. We have Austria shut down. We got supply chain issues over in Vietnam that's affecting. So you're seeing some slowing or reopening in some of those environments, which means maybe we haven't had peak growth yet. Even though some demand is there, they haven't opened up as much as the United States, or we have been fortunate to. And we got that strong growth and strong demand, right? So imagine when the international traveler comes back, which is just starting to open up. Imagine when the economies stop the lockdowns and start really reopening like the United States is. Imagine what that could do, right? So when we want to think about domestic over international, think about growth and value. We talked about valuations as a positive, but maybe a negative too, right? As long as we've got good earnings, the valuations can be justified. But if earnings start stabilizing or coming down, or maybe we're reaching too much, Rivian, for an example, that hasn't really produced, but might have a great car, might be perfectly fine with that valuation 10 years from now or 15 years from now, but maybe not today. So we got to think about growth and value. High multiple, high growth, less proof of earnings, like these new companies like the Rivian, so on and so forth, can be more challenged in a rising rate environment, depending on the pace of it, compared to maybe more of value or cyclical, like banks or industrials, so on and so forth. So we got to think about positioning and where do we position certain things in our portfolio. Do we need to be lopsided? Do we need to have just all growth in the portfolio or just all value? Our general thought, you always have to evaluate your situation and what you're looking to achieve is, it could just be a good barbell strategy. Have good growth, strong earnings, strong cash flow, strong moat to entry or barrier to entry, strong management. Hopefully they pay a dividend, have a history of increasing that. Those are criteria of things that we like in your portfolio, right? As well as, that would translate between growth and value. And then we want some value things. Maybe some things are a little more stodgy, maybe a little boring, but maybe do a little bit better in this environment we're going into, all right? So it's not one or the other. Maybe it's a little bit of both. So as we kind of move forward, then we want to think about, what's the size here, right? So we're continuing with the Thanksgiving theme, right? So in our table, and how do we dress our table? How many people are coming, right? How big does our turkey need to be, right? Are we just feeding just a couple of us? Do we have a big group coming? Do we need to have a turkey and a ham? I could continue on and on and on. But we need to think about who we're trying to feed. For example, how much do we need to feed this retirement of ours? How much do we need to feed these goals that we're trying to achieve, right? So we want to be mindful of that, who we're trying to feed and how. One other theme, and I think it just goes hand in hand. Thanksgiving, football, and the couch, right? Hand in hand. You eat too much, we're going to lay on the couch. Hopefully you're watching football and taking a nap. I hope that falls in that order for you, right? So let's think about it. And I can continue with analogies all day, but I often think about positioning players in the field for a football game. Think about that. You're not just playing offense. You got to play some defense sometimes, right? And not every play in football is designed to get a touchdown. Now, you might say, well, that's not necessarily true. Well, let's think about that. Sometimes, yeah, we want the touchdown, but we know we need to get the first down first, right? So that play might just be to get us a yard or two. Or maybe we need to position the ball in the field so our kicker, right, has a better angle on the field goal, right, to get a couple points. So we got to think about it's not always offense or defense. Not every play or not every position in our portfolio is designed to get a home run. Sometimes we just need someone to advance the ball. Sometimes we need a steady Eddie position And sometimes we need someone that can sprint down the field and run for it, or we could throw a long ball too. So hopefully you like the football analogy and it hits home. But I want that to really be mindful, or would love everyone to be mindful of that when you're thinking about your portfolios, because we get often questions all the time like, why do we own that? You know, it's not doing as well as this or that and the other. And we get it, right? We know certain positions in the portfolio are designed that they have lower risk. Maybe they pay out more income, and that's okay. Because right now, I love stocks with big, steady, eddy dividends and a history of income distribution instead of maybe loading up on bonds where we're going to struggle to get high income and we got to face rising rates, which we know are negative for bonds, right? So maybe we lean to high dividend stocks that have a history of increasing dividend. They got the cash flow to cover those dividends, you know, so on and so forth. So we can use large dividend stocks instead of bonds, or have them in some sort of combination without loading up on bonds, which would be the traditional thing to do to increase income and lower volatility. So there's a lot of different players we can bring on our field to try to win this game, right? So sometimes just be mindful of certain positions in the accounts were never designed to do certain things. They're designed to keep us in the game, get us down the field, so we can eventually get that touchdown, hopefully win the game. All right. So kind of moving here. I don't want to leave this call. We're about to approach some Q&A. I want to really reach out, and we're going to leave some time here for questions and answers, so we're not quite done yet. But I want to take a moment and let y'all know we are truly thankful for each and every one of you. If you're on the call, if you're not on the call, if you're already traveling, you know, thank you. We want to be thankful for what you afford us to do on a daily basis. We love what we do, and we love you. We hopefully you have a time to spend time with your family and find time to be thankful with your family. Find time to be thankful for what we have been given, not just another day, if you might. Hey, Dave, why don't we open up to little questions and answers right now?
Okay, we actually do have a couple of questions here right off the bat. The first one is, where do I see the market going next year? So if you can get out your crystal ball there.
Yeah, I should bring that to the meeting, right? You know, I think we have an opportunity for a good market next year. Now, as we've preached about it and hopefully not beating anyone over the head, just be mindful of volatility is a part of the game. And sometimes we get so comfortable, and I hear this a lot, you know, thank you, the accounts look great. I look at the statements and they go up and up and up. And that's great. We love that. Obviously, that's a direction we like, right? But just know it's not always going to be in that direction. We certainly want that, but we're going to have some ebb and flow. We're probably going to be moving into a bit more volatility as we're trying to digest rates and the effects on their market, growth versus value. You know, people that are considering taking profits with and offsetting losses against those profits as we're moving through the end of the year here into next year. So just be more mindful. I said, I do think we're going to have a good year next year. It might not be as good as this past year or the year before, but I think it'll be a good year, maybe in the single to high digits. Again, I don't have a crystal ball on that.
Okay.
Yep.
Another question is, do you see any of the crypto plays being considered more mainstream in the near future?
Yeah, absolutely. You know, again, it's not going to be an area that we recommend for clients because it's not mainstream. It's not regulated. And if it's not regulated, I'm not trying to put my compliance hat on, but I will. It's not regulated, so we're not in a position to make those recommendations. But absolutely, from Bitcoin to Ethereum, again, that's not a recommendation, but those seem to be the ones that we hear about the most as being a bit more mainstream. And eventually probably moving into a regulated investment on the exchanges. But at this particular point, they're not. But probably more Bitcoin and Ethereum, at least is what we're hearing. But again, that's not a recommendation to buy or sell. But excellent question. I know it's front of mind for all of us.
Okay. What better growth or value investments? What's better?
Yeah, that's a great question. Which one does better, right? Right. Well, in certain periods of time, right, growth, right, with high valuations and valuations that need more time to be justifiable from a fundamental or balance sheet standpoint, say a Rivian or a Tesla, so on and so forth, in a rising rate environment, they can be more negatively affected. Now, over time, they might outperform, but initially they could underperform where more in interest rate or inflation positive, like value, maybe some banks that are interest rate sensitive to the positive, maybe some industrial, so on and so forth, and some consumer side, as long as demand there, could outperform. Now, which one's better? I think we've made the case with our clients. You can certainly see it in the allocations. We're not picking sides at all. We think both of them in a properly planned portfolio can do quite well. We just got to make sure you got the right allocation, right? And let me take one other step on this, if I can, Stacy, on that question. I would like, if we could, to step back as consumers, as advisors, as professionals in this industry, to step back and not expect everything we do to knock the ball out of the park, right? The last couple of years, we've seen the S&P up 70% from the lows, or 80% from the lows. I forget exactly what it is now. Incredible returns. We're up 25% this year. Last year was a great return, so on and so forth. We've had some stocks up 100, 200% in our portfolio. I love that. I love that for each and every one of our clients. I love that we've all had the opportunity to experience that. But I think we also need to have our mindset start changing a little bit and think out in the future a little bit, right? Just because something's down doesn't mean it's out, right?
Mm-hmm.
It's not performing today, but it doesn't mean it's not going to perform. So we need to give some things and just be mindful. If everything is still in place and it's down, maybe it's an opportunity to maybe add more to that and wait for it to outperform, right? Now, there'll be a period where we just have to make a decision. Do we keep it or not? Do we cut our losses and move on? But sometimes I think in this environment where we feel like everything just happens so quick, it's been so positive so much for so long, that it should just happen overnight. And we still might have some of that, but I think we're moving to an environment that we just need to be a little more humble in our expectations, as humble pie, right? A little more humble in our expectations going forward. So I'll leave it there. Thank you, Stacey.
Okay. Sure. We just had another question come in. Do stocks do better in a rising rate environment?
Yes. If you were on the last call, I think we had it on the last call or the lunch and learn before that. We were talking about, we laid out some statistics from the Loophole Group, Jim Polson, excellent. You can always go back and reference that, where we looked at in a period of time where we had higher inflation, higher rates to a certain point. Actually, that is a vote of confidence, and we saw outperformance in the investment markets. Now, there is a point where it's not advantageous. Let me give you an example. If interest rates, let's say, rise above 3.5% to 4%, that may not be, let's say on the 10-year treasury, that may not be advantageous. Why? Think about it. If you have debt out there and you got to pay off that debt, and the interest on that debt, right, is higher, so you're paying more of your profits and revenues to paying off debt, and it's not going back into RMD or distribution or buybacks, you can now probably get the idea that could be negative, right? So there will be a point in certain sectors, there could be a point where it's not going to be a positive for the market. We're not there. We're not there yet, right? I don't see we're going to be there in the next 6 months or a year. We'll just have to see, because again, it's the pace of increase. And also think about it this way, the market's always thinking ahead, right? So it might start having its gyrations, in account for higher rates before rates ever get there. So that's why we're always thinking here about planning ahead. Yesteryear was great. The past leaves clues. It does have some rhythm to it. We know that. We're mindful of it. We're students of the past. So hopefully we can positively affect ourselves in the future, right? Education's power. But at the same time, we don't want to plan portfolios off the past. We've got to plan for the future. We've got to be thinking, hey, what does this thing look like when we're out of pandemic? We got to think about, what does it look like 2, 3, 5 years, 10 years down the road? which is tough, right? Not just 6 months or 1 year. So I hope that answers that question.
I think so. And I guess we can probably wrap things up. And I wanted to just thank you, Graham, for that insightful presentation and for reminding us all that we do have so much to be thankful for. And of course, one of the things that we're always thankful for is our viewers who join us each month for our webinar. And we hope to see you all again next month for our Lunch and Learn. Until then, please remember to follow us on social media and check out our website for our weekly wrap-ups and recommended articles and other valuable information that we place on there. And we do wish you and your family a very wonderful Thanksgiving. And thank you so much.
Happy Thanksgiving.